Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Abhilash and welcome to Cut to the Chase, the podcast where we focus on market events that truly matter. It's start of a brand new week and one which I believe a lot of investors will be starting with a dose of optimism. Global equities closed higher last week on the back of strong earnings, which is clearly a welcome change for equity investors after the tough start to the year. For bond and income investors, the big development was that the global stock of negative yielding bonds fell sharply over the last week to below $5 trillion for the first time since 2016. Now, admittedly, generating income is still challenging in today's environment, but recent developments are a big change from late 2020s when we had over 18 trillion worth of bonds offering negative yields. Now let's shift our focus to equity markets. It may not be obvious from the front page headlines, which were dominated by the sharp decline in Facebook or Meta stock price last week, but earnings in US have been fairly strong over the past couple of weeks. The consensus Q4 earnings growth estimates now stand at 23% versus 16% growth expected at start of the year. The biggest driver for sharp upward revision has been technology sector, where earnings have surprised to the upside by an average of 8.8%. Hence, in the coming weeks, earnings will continue to be a big driver for equity markets. Now, on the data front on Friday, US jobs data was stronger than expected as 467,000 jobs were added in January versus consensus expectation of 125,000 jobs. However, one of the most notable developments was the increase in labor force participation rate, which meant that despite strong job creation, the unemployment rate rose to 4.0%. Now, that may give the Fed a bit more room to proceed with rate hikes at a measured pace as guided by numerous Fed speakers last week. The other big development obviously came from Europe. So Bank of England hiked rates for the second consecutive meeting, and ECB indicated that it was open to hiking rates in 2022. All of this comes on the back of stronger than expected inflation in Europe. And hence, probably the most important data released this week will be the US CPI inflation data scheduled to be released on Wednesday night. Now, markets are expecting inflation to rise to 7.3% year on year, the highest level in 4 decades. And should the inflation surprise to the upside, there is a risk that it may lead to renewed concerns around the pace of Fed rate hikes. Hence, although we've seen the equity market volatility in US measured by VIX index drop from close to 40 to around 25, it is possible that it may spike again later this week. That being said, given our expectation of slower growth and inflation in second half of the year, we would view any potential pullback as an opportunity for medium to long-term investors to add exposure to US equities, one of our preferred equity markets. Lastly, financial markets in China would reopen after a week-long Lunar New Year holiday, and it would be interesting to see if Chinese equities catch up to the global equity market rally we saw last week. Now, if you enjoyed the podcast, please don't forget to rate and like it. Thank you for listening and wish you a very happy trading week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.